What's up, everybody? Welcome to another Monday night. It's Monday night, right? Monday night call. And first and foremost, I know you guys all been looking at this thing the entire time. So this is how you get onto a deal. So we've been talking about deals in Las Vegas and how we need to bring art to the space. And one of our attendees on this call, a dear friend of mine, has been saying, hey, let me come out there and start painting and put murals on your building. I'm like, okay, yeah, we'll talk about that. Then he says, I need to give you something before your Monday call. So I'm in Florida right now. And Luis, the artiste, came over and dropped his hat off. And for those of you guys that do know me, know how much I love Dragon Ball Z. So this is Goku right here on the top of the hat. It says Super Saiyan Legend on the side. And it's a friggin' 10X hat. And he put my little symbol on the back too. I mean, this is the best gift probably that I've received in my life. Sorry, Babeski. I know you've given me some great gifts. Even my wife agrees. All right. This is insane. All right. So let me put that back. With that being said, let me put my virtual background back on. One sec. All right. Thank you guys for coming. And today, I know so many of you guys have been asking me about tax related things. And I've been sharing what I know about it, how I haven't paid taxes for the past 4 years on my tax returns. And hopefully we do the same thing in 2022. But I brought someone that is very knowledgeable in this field. He has been on this call before. The last time he was on this call, I know a lot of people on this call reached out to him. So I made sure that as he, being on this call again, that he will be prepared to handle all of you guys messaging him and calling him, because I know you will after what he shares today. And my goal is to try to stump him today. I gave him some stuff that we might talk about, but I'm going to try to stump him. All right, a lot of questions came my way that stumped me, so I'm going to try to stump him with it. Before we get into that, just a quick introduction of myself if it's the first time that you're here. My name is Alex Lovely, and I am the creator and the founder of this Monday Night Call. We've been doing this for a little bit over a year. And if I don't know you yet, and we're going to be friends, let's be friends on Instagram. So find me at Alex Lovely. And you can take a picture or whatever of you attending this call tonight and tag me. If you tag me, I promise I will follow you back and we will officially be friends. What else? This call, I lived in Peru in 2020 or 2021. Yeah, 2021, I lived in Peru. And I was able to live there off of my real estate income. And at the time I was like, listen, there's something about what I'm doing that everybody needs to get. Okay. And it's through real estate. Everybody needs to get this, because you can live where you want to, you can be where you want, you can do what you want when you have the right amount of real estate income, the right passive income. And so I was able to live in Peru without working at all. All I did was play the guitar. I learned to play the guitar. That's all I did. And fast forward to to 2022, no, 2021, end of 2021, I wanted to teach this. And it was about the same time that I got into multifamily, and it was a great segue. It forced me to play team with people. I was doing real estate kind of by myself. I have partners, I have people that I brought on, investors, but multifamily forced me to play with a team. And it forced me to level up in not just the people that I invested with, but my CPA, my attorney, You know, all the people that bookkeeping, right? Everybody needed to level up on my team. I could no longer be, you know, use the CPA that I had since I was, you know, when I first got into the game. So real estate, why real estate? Real estate is something that gives you cash flow. Okay. It also appreciates over time. It's a hedge against inflation. And taxes. Taxes, if it's just taxes, if we just think about taxes itself, it should be enough to push everybody into real estate. All right. I believe personally that taxes dictate the direction of where we should be going as a human species almost. Right? Because there's times where they'll give out tax incentives to have more kids. And then they'll send out, and then there will be tax incentives that don't give you anything if you have more kids, right? And then there is, if you own businesses, gives you write-offs. If you own real estate, it gives you write-offs. And the really awesome thing that I found about real estate is something called depreciation. And Brent and I will talk about this for sure. But imagine having all of your income depreciated, that you didn't have to pay any of this taxes. And then the next year, or if you went to get a mortgage, they actually add the entire thing back onto your income. This is different than writing expenses off. I'll give you an example. My buddy and I, let's say we make the same amount of money, one of my best friends. He made up a whole bunch of things for his expenses. Okay, and he's like, man, I showed every year, I show $14,000 income, and you know, I pay my little bit of taxes, and I just pray that they don't audit me. That level of stress is crazy. Okay, to just pray that the IRS doesn't audit him after he does his taxes. And the next year, he can't go get a loan for another property because he only made $14,000 because he wrote everything off. Me, on the other hand, I have the exact same income as him. And my taxable return at the end of the year was negative $199,000. Next year, I go get a loan. They take the entire amount that I've depreciated and add it back onto my income, and I can go get my loan. And I'm not afraid because there's no unethical things that happen. I didn't write off things that were not written, that's questionable. It comes from investments, it comes from real estate, giving you depreciation on your real estate, on your income. Okay, even worse, or even better, is I go and get my health insurance. And my health insurance is literally telling me, hey, you make no money, so we're going to have to put you in the $20,000 a year category, which made my insurance $45 a month. And I'm like, this does not seem right. I don't think we should be doing this. They're like, okay, well, if you want, let's put it up to $100,000. Worse insurance, a worse insurance plan, $850. I'm like, put me back down. Give me the $45 a month health insurance. You know, so everything is pointing to, listen, do real estate. Do real estate. Every aspect of it has your back. So I don't know. That's enough of my intro. I was just kind of filling up some space while everyone jumps onto this call. But I do want to hop right into it and give you guys sort of an agenda of what we're going to cover today. We're going to talk. I'm going to bring my special guest on to this call, and he's going to share, and we're going to ask him a lot of questions. And he's going to tell us, he's going to give us a lot of golden nuggets. And then you guys will also get a chance to ask him any questions that you may have. And then we will go into a breakout room where you guys can meet each other. That is probably one of the most, the best part of this call is when we break out and you can meet somebody else in this call. 87 people, probably going to be like 100 people, something like that. But you guys will break out into separate rooms, introduce yourselves, where you're from, what do you do, what services you offer. I don't know, whatever. Just connect with each other. Okay, so you get an opportunity to do that. I'll also give 2 people on this call a 3 or 4 or 5 minutes to share something that I promise I give them the space to share. All right. So without further ado, I want to bring my CPA, Brent BEMENT, on here. He is I got your real phone number now. So
He's got my cell number. That's a next
last
level
time
client.
after this call, a whole bunch of people messaged them, and I'm trying to schedule a call.
Oh,
and my
yeah,
call,
you're not giving out my cell number, are you?
it was no, I'm not gonna, but it was a month and a half, like a month out before I could schedule a call. I'm like, dude, what happened? Like a bunch of people called you, reached out to you. Don't put me all the way back there. So now I got his phone number. Don't worry, I won't give it out. So
Okay.
I want to introduce him. He's been really, he's next level. He's an LP. He's a GP in different deals. I think that's one of the first criterias if you're interviewing or looking for a new CPA, is that somebody that he's already in this game. He knows the game. And I think the questions that we can start with today, Brent, is I guess you can introduce yourself first, and then I'll ask you some questions.
Okay, very cool. I'm looking forward to being stumped. I've been stumped before, and I expect to be stumped, but we're always learning. So, but a little background. I live in, I'm near Salt Lake City, Utah, about 10 minutes to the north. I've been investing in real estate since 2008. My first property I bought like in June or July 2008, and the market crashed. Real estate crashed shortly after that, and I still got that property, and I'm glad I hung on to it. But I've been in about 14, almost 15 years. I am a CPA. I've been doing the CPA work since about when I started real estate investing. It was a family business. I grew up kind of in a strange way. I wanted to be a CPA when I grew up. My dad was a CPA, and I'd be 15, 16 years old, and people said, "What do you want to be when you grow up?" And I wanted to be a CPA. I just thought it was cool, and it was pretty fun carrying on the family business since my dad passed away about 6 or 7 years ago. So I do have, well, I loved hearing Alex's story of real estate, because I think as you guys are thinking of the questions that you have, hearing other people's experience with it, the benefits that they've experienced, and just kind of like trying to figure out how you can apply those and implement those changes or the real estate benefits in your strategy and in your investments. It's just kind of good to hear that. It's great to hear that. So Alex, if we want to, I could jump into whatever you'd want, or we can jump right into questions. What do you think?
Yeah, so let's go into this conversation first. So, I think a lot of people understand that you can get depreciation and tax write-offs in real estate. Now,
yeah,
I want to focus today's call because we talked about it last time. So if you guys want to know more about cost segregations, depreciation, my YouTube video with Brent, the interview is up there. Nick, if you want to throw that in the chat of where to find that video. But let's go a little bit deeper. How do we give our investors the best returns? Like what is the are the best write-offs, right? Because just because somebody invests into a deal and we give them a K1 does not mean that they can just take it and write it off against everything, right?
Right. Yep. Okay, let's jump into that. I'm going to share. Could you let me share my screen over here?
Yep.
I will get that going.
Go for it.
Okay.
He loves drawing just like how I love drawing too.
Oh, yeah, I love it. All right. You should have the whiteboard now. You see it?
Yep.
Okay. So you've got to understand the problem with, or like the problem we confront, or a lot of the problem that people face when they get that K1 when they're an LP investor. Now, oftentimes they might hear from their CPA or tax preparer, or they might just be doing their own taxes. And they're like, well, it says I got a $50,000 depreciation loss, but why is it not offsetting my income? So the key word here with the IRS in this type of loss is a passive loss. And just as a quick example, let's say you got, I don't know, let's say you got $200,000 of, let's say it's W-2 income, and you invested, let's say you invested $100,000 into a deal in a year, if you invested $100,000 over the last 3 or 4 years, because of accelerated depreciation and stuff, we were able to get each investor usually between $60,000 and $80,000 of a deduction on, say, $100,000 investment. So what you'd love to see, if you invested that $100,000, you'd love to see your income to come down by 80K, and then you'd be paying tax on 120K. So that's like the ideal situation, but there are some specific hoops you got to jump through, because that loss right there, that's typically a passive loss. And so just as you're investing, you got to understand what's a passive loss, what's a non-passive loss, when you can use them, when you can't, what type of income they can offset. So we'll go into some of that. So if you are, let's just say you're a 5% owner in a deal, you invested that 100 grand at the end of the year, and you didn't do any other restructuring at all. You just invested the 100 grand. At the end of the year, you get a K1. And this right here, this is the K1 that's reporting the $80,000 loss to you. You're likely not going to be able to use that loss in that year if that's all you've had going on. So now we've got a mission, and our mission is like, okay, what can we do with passive losses? How can we convert? We got a couple questions. How can we convert passive losses to non-passive losses? And then the other question is, how can we use, what can we use passive losses against? And it's passive income. So the other question is, how can we create passive income to use passive losses? And I'll go into some examples of that. So let's say, and then now that we're talking about GP deals and LP deals, here's my brief summary of it. And we'll just use this in the just ongoing in this example here. So let's say you are, I'll kind of draw out a full deal. Let's say you got a GP person there, and let's say this GP brought on 4 LPs, and it's general partner and limited partner. And let's say you go in on a deal, and let's say the GP owns 20%. And then let's say each of the LPs owns 20% each. And this triangle right there, that's going to be an LLC typically. Like most of the time it will be an LLC. And then that LLC is what will own the property. So in this kind of chicken scratch example here, GP, what this means, the GP owns 20% of this LLC, and that LLC owns 100% of the property itself. And the same thing goes with the LP. So each of those LPs would own 20% each. So when we're talking about, that $100,000 example I gave you, as the LPs put in their money, they're putting it into an LLC. This is going to go out and buy a property. And let's just say it's $1 million property. On that $1 million property, let's say you get $250,000 of depreciation in the first year. That's depreciation. We're going to split that loss, whatever it is, along with the other expenses too. If you're paying utilities and mortgage interest and stuff, we're going to split that right there based on the ownership percentages. And GP is going to get a K1. In that example, what's the math on that? He's going to get a $50,000 loss. And then each of the GP LPs is going to get a $50,000 loss on the K1. So just understand that structure and how the deductions flow up to each person. So what the specific example now that we're talking about is this LP. All of a sudden this LP's got some income, and I'll kind of redraw it here. The LP has 20% of this deal here. And we just sent $50,000 from the deal that owns the property, a $50,000 depreciation deduction through the K1 up to the LP. But now the LP, if you didn't do any other restructuring, you might have some issues. You might not be able to restructure that. So, or you might not be able to deduct that against your income. And we'll go with an LP. Let's just say there's 200K of income. So here's one of the ways that I would recommend being able to convert your passive loss here with the $50,000, converting that, or being able to use some deductions related to that. So one, of course, if you have a lot of passive income already, this is the simpler example. So I'll give this one first. let's say this LP owns part of a business and they don't participate in that business a lot, or they're a passive investor in that business, or they're just an owner, they're a passive owner, either investor or owner of that business. And let's just say there's another business over here. So let's say this business is giving them, in this easy example, let's say they're making $30,000 a year through a passive investment in a business, which would be great, right? We want passive income. We don't want to have to spend a lot of time working because we can multiply our efforts. So in this brief example, we've got $30,000 of passive income. We have $50,000 of passive losses, and this investor makes $200,000 on a W-2. So the way it's all going to come together on their personal tax return, it's going to look like this. They're going to have $200,000 of W-2 wages. They're going to have $30K of passive income. But because we have passive losses that are coming from the depreciation on the real estate, that's on this side, that's the real estate side, we can use $30,000 of that $50,000 loss to offset all the passive income. And so now their taxable income goes here. Their taxable income goes to $200,000. So that answers one of the questions of the type of income that we can use to offset, or we can use passive losses to offset, and it's passive income. And that's if you have real estate deals, like say after the first few years when you accelerated your depreciation, when you start making a profit, you have a lot of cash flow and not enough deductions on your real estate investments, those are all going to be passive loss, or those are all going to be passive income. And these passive losses, as you're getting into new deals, can offset that income. So just make sure you're understanding like what income is passive for you, what is like your W-2 wages. And then if you have investments in other businesses, I know a lot of you may not, if you're mostly interested in real estate, you might not have a lot of other businesses. But if you're self-employed or you're part owners, this section over here could apply to you. But remember, it's the way I've drawn this is like in two separate LLCs, but really I could draw it 100 different ways. It could be, you could have LLCs directly underneath you. You could have S corporations, partnerships that you own. What really it comes down to, if you have passive income, we can use those passive losses to offset it. So Alex, any questions so far on like
So there's a
the
bunch
main
of
answer? Yeah, go ahead.
let's take some questions first. So Sylvia's got his hand up, and those of you guys that are putting questions in the chat, I don't know, just raise your hand and ask it. So Sylvia's, go ahead, you first.
Thank you very much. I have a question. I own Airbnb, short-term rental. Is that considered passive income or active?
Okay, that's a great question. The short-term rentals, there's a whole different type of tax code for short-term rentals if you are actively managing them. If you're the one spending the time managing those are not going to be passive. So as a quick example, like let's say, well, it's kind of a messy drawing here. I'll just explain it. If you go out and buy $1 million Airbnb on your own, you're the one putting the money down, you're the one running it, you're not going to be subject to those passive loss rules. You're going to have that $250,000 to $350,000 deduction that could go up and offset your W-2 income up there. If you and a friend went in on it together, you could likely both have it qualify as not passive. But if you invested in Airbnb, in this example here, like the GP-LP structure, if you're an LP and they happen to invest in an Airbnb property and you're still an LP, that would probably still be passive. But if you're going out and buying a vacation home, a cabin, a rental, something that you're managing, there's a whole nother set of doors that like opens up for you as far as the deductions go.
Yeah, question goes even deeper than that because my wife is doing it, but I don't know how it's considered. I have an LLC. I purchased it on the LLC, but my wife is doing all the work. And
great. Do you file a joint tax return with your wife?
we do. Yeah, unfortunately we do.
Well, that is very good. It's great that you do that, because I would have her on the LLC. And it's, yeah, if you've got a partnership, make sure she's a member of that partnership, that tax return, because that's where the deductions would be created. So let me do a quick example. We'll just do husband and wife there. Let's say you got an LLC. And let's say you got, let's just say you've got 50% ownership each, and you go and buy, and you've got the Airbnb property there. This green triangles, that's your LLC. So if you go and buy, well, the easy math is $1 million. Let's say $1 million property, the depreciation on that, let's say it's 250K. We're going to prepare K1s. It goes up to each of you. And these are going to be non-passive K1s. We might even want to consider putting her as a 99% owner, and maybe even putting you as a 1% owner, because then we'll send about a $245,000 loss to her. And for her, because she spent the time in it, it's not going to be a passive activity for her. And because thankfully, I think you said unfortunately, but thankfully you file a joint tax return. So what it'll look like for you, say you've got 200,000 of wages, the $200,000 of wages can be offset with this $245,000 of Airbnb losses from the depreciation. And we're going to end up with a negative 245 or a negative 45. And that's going to carry forward to 2023. If you bought it in 2022, we're going to be able to use that over in 2023. So that's like short-term rentals. Like there's a ton of information online about like the short-term rental loophole in a very informal kind of scribble mess. That is the short-term rental loophole right there, where one of the spouses can be a wage earner earning ordinary income. Another one of the spouses can be focusing on the real estate and doing the short-term rental loophole, where it's rental property, rental like real estate that is non-passive because of the way that you're operating it. And the rule there is that it needs to be 7 days or less, the average rental period. So you got to watch out. There's like kind of some of these short-term, like 1 to 3 months, like the nurse rentals, those wouldn't qualify as the short-term rental loophole. It's got to be 7 days or less on average. Like when you go back and look at your listings for the year.
I'm definitely there 7 days. All right,
Hey,
I'm gonna need your services after this call. Thank you very much.
Hey, Brent.
Yeah.
Like, why is this? So 245K going to the wife who's non-passive. How does that go up to the the joint? Oh, because she's a real estate professional or what?
Well, and that's another one of the loopholes that we can talk about, but because she's non-passive, her non-passive losses can offset all the joint tax return filing, because they file a joint return, their income and deductions, they're reported on the same forms. So because of that, one can offset the other. So so make sure like the short-term rental loophole. So in real estate, all of these, I mentioned the passive losses, and in a way I kind of mentioned how horrible passive losses are. Like it's like, oh, like how they could be like not used and we'd have to carry them forward to future years. They're not great. So some of the ways around them are having passive income, doing the short-term rental loophole, or being a real estate professional is one of those other ways to do it.
Okay, so wait, let's go over those three again. So it's either being a real estate professional. What did you say the three were?
Yeah, real estate professional is one of them. The short-term rental loophole, or having passive income to offset it.
Wow. Okay. Awesome.
And I'll give you a fourth. This fourth one, we might need like another hour call to go over the fourth one. But it's becoming a professional investor, not a real estate professional, just acting and setting up your entities like a professional real estate manager in a way. And I'll even give you an example of how that would work here in a minute if you want.
Okay, so well, we have a lot of questions. So let's go with Hawk first. Let's see what we got. Go ahead, Hawk.
All right, thanks, Alex. Thanks, Brent. I mean, I've been waiting for a long time to talk to you. So I'm in this unique position where I probably hit like 750 hours in like less than 2 months, right? Because I'm like constantly underwriting, looking at deals, starting businesses, and passively investing. So, with this, I know I'm kind of splitting between all four to some degree, but how would I be considered an active? Be actively investing or active real estate professional if if I definitely meet that criteria for professional real estate investor. Do I get to carry any write-off like my LLC, passive investments, expenses on education, stuff like that?
Yeah, great question. So I'll give a quick example or the quick summary of what the real estate professional is. And you already know what it is, sounds like, because of the 750 hours.
And he's also full-time W-2 though, so keep that in mind.
Yeah.
Okay.
Yeah.
So we got two hurdles to cross for Michael to be a real estate professional, and really not just for Michael, but for any of us to be a real estate professional. We need to spend 750 hours or more a year in real estate related activities, and we need to do more real estate more than our other job. And I'll give you some example. Like, we do have some full-time employees that are real estate professionals. Like, they're full-time employees that are doing something else. Like, I don't know, like a flight attendant spending 1,500 hours on a full-time job. Some of these people spend so much time in real estate, or they're spending so much time like constructing a new one, or every weekend and every night and every possible day they can, where they do spend more hours than their regular job. Then they could meet that. But you got to meet both of those tests. And that's just part of the IRS requirement. So 750 hours in real estate related activities, which is managing your rentals, constructing your rentals, working on them, managing your tenants, buying the real estate, researching, like, not general education doesn't count, but like researching your specific property, doing like feasibility analyses or getting the loan. It's a massive undertaking, as a lot of you know, like just getting a loan on the property and going through the underwriting process. But all that would count towards your hours.
So underwriting process counts. So if people are just underwriting to get into the right deal, does that count?
Yeah, it would. Yep. But so there's if you meet those real estate requirement rules. So Michael, I don't know if you'd be able to tell us, do you think you spend more time in real estate than you do in your job, your W-2 job?
It's probably close. It's really close. I mean, I have a normal 80-hour pay period, so it's gonna be tough. Yeah. So
Okay.
probably not if we break it down. They'll probably challenge it.
Yeah, because it'd be hard. Like on one hand, you could say, well, hey, I spend half my day at my job working on real estate or working on deals and stuff. And I think that's true with a lot of people. Like, on their day job, they might be doing real estate during their day job. But I do agree, like with the IRS, if they tried to challenge it, they'd say, you got paid for 80 hours these 2 weeks. How are you going to claim those hours for real estate hours? Like, it would be hard. But the reason we're talking, for everyone else, like the reason we're talking about this real estate professional status, because when you cross that threshold and you become the quote unquote real estate professional, it is not a real estate agent. There's no licensing or testing or anything. It's just those two requirements I mentioned, the hours and the time. All of your real estate investments could be considered non-passive, and you could start offsetting your regular W-2 wages with those real estate deals. And that counts for your spouse. So if you do file a joint return, like that one example we gave up here, if your spouse is a real estate professional, we can have losses like released through your spouse because they're a real estate professional. It can offset your W-2 wages. But in Michael, in your example, we'd probably want to get into the that number 4 solution, or we could jump into it now. It might take some time, but there's another solution that I'd recommend for people that you're actively involved in it. You're basically managing your own investments. And there's an entity structure I'd recommend for people like you to do that when you're not a real estate professional, but to still be able to write off some of the related expenses.
What is it called?
What is that structure called? or like the fourth recommendation. I don't have a name for it, but like the summary of it is setting up a like a professional investment manager entity structure. And it involves setting up just a quick summary of it, another LLC. So one LLC that you're owning this is going to be quick. So you're going to have one LLC that owns your investments. So Michael, this is for you. This is your investment LLC. So that's investment LLC there. You're going to go invest in your LP deals through that. Or if you have your own deal too, like a long-term rental or whatnot, it wouldn't be short-term, or if it's not short-term, you're not going to have the short-term rental loophole. Invest in your own deals, your LP deals, put that under that LLC. And if you're active enough in it, which you spend a lot of time in it, like you spend more than 750 hours, there is another hour rule, which we can go into all the details on that, but there's a 500-hour rule where if you're spending more than 500 hours, we'd probably have you go and set up you probably can't read that, but an S Corp where you are actively in it or actively running it, and you are, say, the only owner in this example. Through your S Corp, we'd have you write off your, let me just put this, like your education, your travel. These are going to be your non-passive deductions. These are your deductions that you are actively involved in this. So education, travel, just say you've got meals related to like getting the education or getting the properties, I don't know, bank charges, phone. I can't even read my own handwriting, so sorry guys. And then what you do here, you'd have one of your companies, well, not one of your companies, this S Corp would charge a management fee, and you'd have your investment LLC pay the management fee, because your S Corp, it needs to have an income source. And that management fee, let's say it makes $1,000 a year in a management fee, but then you're going to go and write off all these deductions down here. Say it's 10 grand. You're going to write all that off, and you're going to have a $9,000 loss. Now this $9,000 is going to go back to you on a K1, and that's going to be non-passive. And then you'll be able to take your W-2 wages. And while you'd still have, we haven't released all of your passive losses through depreciation. That's the limitation with this structure here. It's like your specific investments are still passive, but your deductions related to it, you could convert those to be non-passive. So not as big of a impact here, but potentially like $9,000 or whatever all your costs are down through your new S corporation here. Those are the deductions you would take. But that's when, like, that's the structure we'd recommend if you're limited. You don't have the short-term rental loophole, you don't have passive income, you don't meet those other three tests. This is kind of that Hail Mary, like last ditch effort.
So there was a question this week about the self-directed IRA versus the STEP. What is the QRP?
Like a qualified retirement plan?
Yeah. Which one's better for taxes? Because from what I understand, there's UBIT tax on the self-directed IRA, and if you have a QRP, it doesn't count. So yes.
Okay. So the question is, which one is better for investing in real estate, right? Like,
Yeah.
Either through a SEP, like, was that one of the options? Like, if you're self-employed, you have a SEP IRA, or you're saying like a solo 401k or a solo
Self-directed.
More like the solo 401k, because I would be more under the qualified retirement plan as far as I know.
Okay. Okay. Well, yeah, the UBIT, what does that stand for? Like the unrelated business income tax. That's, well, I know, like, if you've got a foundation or a nonprofit organization, I know you can run into some issues there, but I honestly, I don't like self-directed like IRAs, like as a kind of like this last ditch effort I just gave you. I don't like it as the first option, but as a fallback, and I'll tell you why I don't like it as the first option, because when you have it in those plans and your assets appreciate in value, when you're pulling the money out of those tax advantaged accounts, like the QRPs, you got to pay tax at your ordinary income rates. There's not really like a last step like the buy, borrow, die method, where you can die and donate, or your heirs can inherit your assets tax free. You can't do that with the QRP type of plans, or any type of retirement plan like that. But the advantages to them, and this is why a lot of people do them, because one, you've usually got money in those accounts already, and it's a self-directed. Say you've been putting money into 401k at an employer for 10, 20 years. Now you got 300 grand in there. You're like, I don't want to withdraw this and pay tax on it. I want to just transfer it over to a self-directed plan and get into real estate. So like that does make sense in some situations. And really, if you're in a situation where you don't meet the like those ways to get away out of like the passive loss rules, and you're not going to be getting a big deduction anyways, if you're going to go invest passively, the self-directed accounts actually can be a really good tool for you, because you're not going to get a big deduction anyways. And so you're not losing out on the deductions, and you're not paying taxes. The income comes out to you to go invest it otherwise. So putting it through a self-directed IRA as an LP, I think could be a great tool. But there's a ton of variables. I would say just run the number, just compare it out 10 years and see which is better for you in the long term, or 20 or 30 years, however long until retirement, and just see which is better in the long term, because it's like a year by year basis, you wouldn't know, but long term, you can figure out what would be best.
If somebody were to call you, is this something that you could help them get clear on?
Yeah. Like
Okay.
in a 15-minute call, no, but like as part of the strategy and planning process, yeah, building out a 10-year projection is something we do all the time. We just get everything that you're into now, kind of look at the values of it, look at your tax return, and then we just go, okay, when do you plan to retire? What do you want to do in 10 years? Do you want to keep getting into real estate? Do you want to get into being like an active real estate investor at some point, or do you want to stay passive? Like all those answers would kind of change our answers on how to plan and strategize for it.
Okay. All right. Brandy's got a question, and then Nick and Maria, and then McGenna. Okay, cool. Let's go through the questions. Go ahead, Brandy.
Hi, Brandy Edgecombe from Philadelphia. I had the exact same question that Michael had, so I guess I'm going to kind of tag on the back of that. I'm in the exact same situation, got a W-2, want to take the tax advantages. So I think your fourth strategy for me would probably work. Question though, assuming I set up a structure like that and I start investing now, and I get to the point where I can become a full-time real estate professional in the eyes of the IRS, how does that change? And do I have to change my business structure? Or can I just, like, one day I'm not a real estate professional, I have that structure set up for the tax advantages, the next day I am, and I can take the depreciation on top of it?
Yeah, really good question. There is, other than checking a box on saying yes or no if you qualify as a real estate professional, that's all that's different. It would, and it, or
Okay.
checking a box saying this is passive or non-passive, that's all that's different. So the LLCs that you set up now, say as a passive investor, in 3, 4, 5 years, if you're like, this is me full time, I'm a GP or I'm active, you're getting in your own properties, you could use those same structures. And it's just a classification of the income and not like a change of your entity structure. So anything you did now wouldn't be wasted.
Do those losses carry over?
Okay.
Yeah, great question. Yeah, like the passive losses. So where we're limiting a loss, like in this first one, we were saying there was 50,000 a loss and we only used 30. There's a passive loss carryover of $20,000 that we're going to carry forward to the next year. And in the next year, if say you sold that property and you cashed out, that 20,000 could be used to offset that. Or you have a rental property that starts cash flowing really well and it exceeds the deductions, we can use that. So you don't lose it. That's very important to understand. Like I have walked some LPs off a cliff before, or back from the cliff, not off the cliff, walked them back from the cliff saying, you're not losing this. You're not losing these deductions. They're just not used this year. It's a benefit that you carry with you until you can use it. So that was a great question.
So if people are
So
not,
I
Okay, go ahead.
sorry, go ahead.
If people
I
are
have the same follow-on question because I do. I'm sorry, Alex.
No, you go,
I
you go,
can't
you
see
go.
you.
You go.
So along those same lines, if I'm understanding you correctly, so I've got an investment property right now. Real estate was never something I was planning on doing. I just, by default, kind of rented a house out when I moved overseas. I have losses I'm carrying forward on it. When I do become a full-time real estate professional, I can take all those losses from like the last 4 or 5 years.
It's the test is done on a year-by-year basis on whether it's passive or non-passive. So let's say in 2022, there were passive losses that were created that year. In 2023, if you became an active real estate professional, new losses created in that year would be non-passive, but your old losses would still be passive. And so they're like, we'll call them like they're in 2 different buckets. And so we'd still be limited by those passive losses from the prior years until you started to have more passive income.
Can you, I have massive passive losses from like it's a negative cash flowing property. Don't get me started.
Okay.
Again, a long story, but so I have some big losses. I can carry all that forward in the first year that I become a professional.
No, well, then like you can carry it forward, meaning that it goes from say 2022 into 2023, but it still stays as passive. It doesn't reclassify it to non-passive. So you can't technically use it unless you have passive loss or passive income coming in, but you can carry it forward. And I don't know, it's like, that's a tax term. And I'm like trying to come up with another better way to explain it. You can put it on a tax form that will just continue to classify it as passive until something comes up where you can use it, but it wouldn't recategorize it to non-passive.
Are we going to have a way to contact you after this? Because I need your services.
Yeah.
I will post all of his things on the
I got a different link, Alex. I got a different link.
Okay.
Okay, cool.
I've got someone that can meet with people. Well, definitely starting this week.
Okay, because
Yeah.
I imagine there's going to be about 50 to 80 people calling you after this call. All right. So
Yes.
get ready. I told you to get ready for it because it's coming.
Thank you. I appreciate
We're
it.
gonna move on. Brandy, go ahead, Maria.
Hey, thank you so much, Brent, for being here. I saw you the last time you were on Alex's Zoom, and I feel like I've learned more since then. So thank you. My question is, I'm trying to become a real estate professional, and I'm looking to source my 750 hours. And I'm starting to make a list. How detailed do I need to be in my list, and what counts? And oh, I'm sorry, my 500 hours. My shadow's here.
Yeah. So the types of, like one, you need to know, or if you're ever audited, they need to know the day, like that you're spending those hours and the purpose for spending those hours. So like some of the categories would be like I mentioned, like managing the tenants, or like say you're getting a listing ready to go, or you're working on acquiring a property, just that whole, right now it's like a 3-month process almost to buy properties, but like the 1 to 3 month process, whatever you're doing there, like I would put in a like a Google Calendar, or however you track your calendar. Like I would put it on the calendar as a separate calendar from your personal one. And then at the end of the year, you can just run a report and see how many hours it was. Or if you're halfway through the year, you can run a report to see what it was. But there's not a, yeah, go ahead.
But do I need to be so specific? And like, if I was at a Grant Cardone event, I know that teaching doesn't count, but networking does. Do I need to be specific with who I'm like, put their name that I networked with this person?
They have, like if you go out to eat with someone to substantiate your meals expense, the IRS wants you to put the person's name. I don't know, I don't think they have that same specific requirement, but I probably would. Like I would list the name of the person, and if you were at the event, of course, like studying or like the education time itself doesn't, but yeah, working on deals and networking with people to help you on the deals and stuff, that time would count. So put
Does
names
this
of
all
people.
count?
If you traveled somewhere, put the name of where you went. And as long as if your schedules, we've seen some of these audits, or not the audit, some of these court cases where the IRS is contesting it. And they're saying you can't be in two places at once. Like you said, you were here, your work had you here, like just make sure your calendars just jive with where you actually were and what you were actually doing.
Does being on this call count for the hour?
Well, if we're just talking about general education, it wouldn't. But do you have a specific deal we need to bring up, Alex? And we'll
But the networking portion of that does count of this call,
Or does it?
right?
Well, yeah, if there's networking and you're creating those relationships to further your, hey, you're all meeting with your CPA. That time counts.
Okay, all right. All right, that makes sense. Thank you so much.
Yep, you're welcome.
Nice. Hey, does like count, like we have, a lot of us have set up one-on-one calls with each other, and they're Calendly like, 30 minutes, an hour, 45 minutes. Do those count if people just track their Calendly?
If it's, if it's just like general education, no, but if you guys are working on deals together, then yes, it would.
All right, great. So make sure you guys are all talking about some deal at least. All right, go ahead, Magena.
Thank you. This is awesome. So one question I have, what if I don't have a W-2 for 2022, which I don't, and I just realized that even if I pay the 10% penalty to retrieve some of the money from my 401k that I had with an employer, and now I'm able to either roll over into my self-directed or completely remove it and apply it as an income, because I realized this very late, does my 2023 action to remove this money from that account count towards 2022? And the reason why I asked that is because when I file for my taxes, I sometimes make investment into the Fidelity, even the year after, for prior year claiming taxes. And that's why I'm thinking, let me ask a silly question and see if there's hope there.
So it was a withdrawal this year in 2023 from your 401k?
I have not done that yet.
Okay.
Now, instead of me doing a rollover from an account that is with an employer I work with, if I instead take it out, pay the 10% penalty, would that count as a 2022 income? Because in 2022, I have zero income from a W-2 and I have a lot of business expenses, and I'm trying to offset some of that, but it's like a 2023 action. So would that apply to 2022?
You know what you could do? So in the year that you pull it out, if you decided to just pay the tax and pay the penalty, it would be a 2023 income item. But you mentioned you have 2022, a lot of business expenses without the income. What you could do, you can file your taxes and claim all those deductions on 2022 and create a loss, and it would create a net operating loss that you could then carry over to 2023. That would be one option of maybe deducting it, which wouldn't give you any benefit that year, but you could carry over some of it to the 2023 tax year and offset some of the impact from your IRA or 401k withdrawal. Or if we claim that you haven't officially started your business yet, because there is some tax law with startup costs where you can't write off all your startup costs until you've actually started the business. If we claimed that your business didn't actually start till 2023, there might be some reason to just hold up on all your 2022 expenses and claim all those on 2023, and to offset even more of your 401k withdrawal.
Which is such an excellent point you make, because I did open the LLC for my business in 2022. However, my business officially started in 2023 because I count as an official commencement, reaching out to my potential prospects and clients. So I have not made any income, and I haven't started my business last year. And I have proved that it started this year because I even posted the logo and the website is coming up. So my thought process is because I opened the LLC last year, then that makes it the year that it started, but not really. Like it's this year.
Yeah. Yep. It wouldn't be off the registration date. It would be when you officially opened for business and started taking clients or customers or.
Oh, wow, this is amazing. So, which means that even if I take that 401k from that account and take chances to have it as a form of income, and at the end of the year, I may end up not even paying the same amount of taxes, given that I have so many losses from last year's expenses to build the business, to bring it to the point where it actually functions and I can start creating income.
Probably, or most likely. I wouldn't want to give you very specific advice and tell you it could be deductible, but if you are self-employed and you're starting a business and you open the doors and you have a big loss, that type of loss is non-passive. I know we're talking about passive loss, but that would be a non-passive loss. They can offset W-2 wages or 401k withdrawals. That's income that could be offset with that type of loss.
Oh, wow. Thank you so much. This is great. Thank you,
Yeah.
Alex, for putting this together. And may I ask one more question? I don't want to sound selfish, but this is for my parents. They have the 401ks. At this point, they don't have to pay the penalty. If I were to invest a lot of their savings over the years into real estate, at the end of the year, does it matter where I invested in order for that investment to count as a loss versus paying taxes? I'm asking a better question.
So if you had like,
So my parents want to invest.
if they kept their money in a 401k and you did a self-directed 401k and invested.
So they have, well, it's not their employee 401k, they're self-directed 401k. If I want to invest 100k of their money from the self-directed 401k in traditional Roth, whatever that is, and then I invested into a real estate property, but it's from that account directly into the 401k, do you recommend that instead of doing that, taking the money out and then invest it, but then to avoid paying taxes because this 100k or 50k would count as income, how can I make it that it doesn't count as income if I were to take all this money and invest it? So bring it to the bank from Fidelity to their own bank, straight into the property, into the multifamily property. Is there a way that it shows that this was actually invested, so it's not income, so they don't get penalized more and paying higher taxes because they also have W-2s?
Yeah, as long as you do either a direct payment from the self-directed IRA, or I'd have whoever's holding, the administrator of the IRA, make sure they're reporting the 1099 correctly, that it's not a withdrawal, that it's just a reallocation of investment funds. That wouldn't trigger any IRS like tax or anything. But we do see a lot of times actually where they file these 1099-Rs wrong, just because they don't know what people are doing with the money. And so they'll treat something as a taxable distribution when actually it's not, when you're investing through a self-directed IRA in the name of your self-directed IRA. Sometimes we have to correct that at the tax return level. But if it's in a traditional like 401k or retirement plan, and they want to get it into a self-directed IRA, I would make sure you set up the self-directed IRA account first, transfer the funds there, and then from that account go directly into the investment.
No, these are I'm sorry. These
so
are
it already is self-directed IRA. Then
are self-directed. But my question is it better to roll over from self-directed into the property investment, or remove it from the self-directed into a regular
pay
bank
tax on
account?
it? So that goes back to like one of our first answers where we got to do the 10-year test. We got to say, okay, it costs this much in tax. If it's in real estate, it might grow to this value. Is it better to be taxed at like a lower capital gains rate, or do we want them to be taxed at the ordinary income rate if we keep it in the self-directed? The
Okay.
longer time you have, the more likely I'm going to say get it out of the self-directed, get it out of any retirement account, and let it be in real estate in your own investment company outside of retirement. But if they have like less time to when they want to start using the money, I'd say sometimes it might make sense to keep it in the self-directed. But that's
a good point.
Yeah.
So I think this is going to be something that if you have further questions, you should reach out to Brent and work that out, you know, because I want to make sure that everybody here gets their question answered. We really only have like 10 more minutes on the Q&A. Go ahead, Sean.
Hey, thanks, Brent. There's a lot of great information. So I have a really quick question for those that are looking to get into a GP role and participating in acquisition fees. Do those count as passive income?
Acquisition fees would typically not be passive. And acquisition fees, we normally recommend having like a separate entity from where you're holding the real estate, and having your acquisition fees going to a separate entity, like an LLC that's taxed as an S corporation.
As an S corp, right?
Yep. So if you're flipping properties, you're getting acquisition fees, your management fees, that's probably going to be an S corporation, like this, wherever that example was, like that example there. You'd have your investment company, and your S corp would be the GP getting the fees on it.
Okay. Thank you. That's all I have.
Yep.
Thanks, Alex.
Yep. Hey, Matthew, go ahead.
Hey, Brent, how's it going? I'll be
good.
quick with my question. In your experience, have you worked with any Canadians to set up their structure?
I can think of 2 of my Canadian clients that have some very complex structures, and we work in tandem with their Canadian CPAs and Canadian lawyers and United States lawyers, but we're typically on the team and giving our input on how all that goes.
Okay, so if I was to book a call with you, would you be able to help orient me to how to properly set up this structure?
I know there's a lot of similarities between the US and Canada. Of course, we don't file any Canadian tax returns, but a lot of the concepts here would apply to both. I would just make sure to tell you, like, this is the US tax law. There could be some differences, and we might want to have an attorney, at least as far as setting up the entities. We would refer all that work out. We wouldn't do any of the setup, but yeah, I would definitely have a talk with you about it if you'd like.
Okay, great. Thanks, Brent.
Yep.
Awesome. Barbara.
Hi, good evening. Most probably it is more specific to a one-to-one conversation, but under the assumption that you own several businesses and there's already S Corp, all of them are somehow in real estate from the structure. What would be, I know you addressed the W-2 situation with one of the scenarios, but if you already own, let's say, one business where you have, like in the past, invested 80% of the time, but you're getting yourself out and replace and have management team in place, are there any scenarios on a high level you can describe how that could work for a business owner?
Yeah. So the long-term goal here is that you would be stepping away from this hypothetical business and creating a passive income stream, right?
Yeah, well, I have, again, in my scenario, only as an example, only to deeper, I have a holding with single family homes. I have short-term rentals, and I have a home staging company. And now I'm getting myself in, and I'm investing in real estate now in multifamily. And I'm really trying to move everything which relates to me into the multifamily stream, and investing passively and actively as a GP, as an LP and GP in that deals, just at a high level scenario, because I assume there are more of us out there who are in a similar scenario.
Yeah. And so really every income stream that you have, we would just classify it as either passive or non-passive. Are you active in it? Are you not active in it. And we could start planning, and you'd say, okay, if you've got, say, if you owned 100% of a business, this and this on the left side here would be the non-real estate business. Let's say if you're making 100 grand a year in a K1 going up to you personally. So this would be your personal taxes. And then over here, if this is your investment company that you're investing or that you're using to invest, investing company, and all your passive deals are over here. And really, you could get to a point where everything is passive, where you've got passive S Corp income coming up to you personally there. And then you're getting into multifamily deals, which is going to be creating a lot of depreciation and a lot of expenses. So you probably have K1s that are going to be generating losses coming up here. Let's just say you got $100,000 of losses from the K1s. That goes up to your personal. Both of them, this is from the S Corp, you got the 100K, and then you got the 100K from the passive investments. That's supposed to be in red, but you could get to a point where you've got all this cash flow, because real estate can still cash flow and show negative on the taxes. Alex kind of started with that, how you can get a lot of the money and benefit of it without paying any tax. They can add it back later for lending. You could have 100,000 of cash flow from a business. You could have whatever amount of cash flow from the rental properties and not pay any income tax at all. So you can live very good life and just have everything offset. But if you're getting more and more involved into this area and you're stepping down from over here, that would still be passive over on the left if you are passive in it. And you could have some deals down here where some could be active, some could be passive, and we really just break it down on a property by property basis on when it couldn't be used to offset some of your other income. But assuming you'd become a real estate professional, so really everything real estate related would all be lumped together anyways. So all your real estate income could be offset by all your real estate losses. That's like, I think it's a great place to be as far as like leaving other jobs and getting into real estate full time because of all the benefits with it.
So really strategically planning, and possibly if you have, a spouse and that spouse is not working or retired or whatever else, put that spouse into a position of taking certain elements of ownership to really reduce the amount of taxes paid overall. I love that. Thank you.
Yep. You're welcome.
All right, let's see. Okay, Tariq. Go ahead, brother.
Hi guys, how are you doing? Thank you for the great information, and I have two questions very quick. The first one if I'm gonna be an LP, is it something can I do with being real estate professional or no?
Yeah, as an LP, if you spend enough hours as an LP, like if you spent the 750 hours and you did that more than your other job, then it could become non-passive. And normally it'd be because you're in enough deals where you're like running your own set of real estate investments, or you've got your own deals where you're spending that amount of time in it. So it's definitely possible to be an LP in a lot of deals and partly in your own deals and have everything combined. There's a specific way to combine all the activity of your real estate, a specific tax election that you could file to allow your properties and all your hours for all the properties be combined.
Great. And the second quick question is how to prove that this 750 hours, like with, for example, I'm talking to somebody, should I take screenshots like about the end of the call, how many hours we talked, or aside of the report that we're gonna have, like I called for this hours, but screenshots kind of like something we can look at, or what?
Yeah. So in the IRS, of course, they won't give away their secrets and they won't tell you what they're going to ask for, but I can give you some like specifics that I know they would ask for. Like calendar logs, like we had mentioned earlier, just knowing where you are, like when you're there, who you're talking with, those types of logs. If you've got screenshots, that would of course help. If you have Calendly reports for when you're actually on calls, like flights to show like, yeah, I traveled there to do this. I have one of my clients, he tracks all of his calls. He has it's like AT&T or Verizon, or somehow he synced it with an online platform, and every single call and every single text, he can categorize it and it'll run reports for him on like how much time he spends on the phone. So all those things could be in your favor when adding up your 750 hours. But when you submit, just so everyone knows, when you file your tax return, none of this is submitted to the IRS. Like they don't ask for any proof up front. I would say make sure you could get the proof, but they don't ask for any of the proof up front. You're checking a box to say yes or no that you qualify as a real estate professional. It doesn't get filed anywhere. So it's just very important that you hang on to those records. So you're not 3 years down the road, you're not trying to scramble for it. I would save it as you go. Your calendars, call logs, travel reports, all those things. Just save them as you go to help substantiate your deduction.
Thank you so much.
Yep, you're welcome.
So for those of you guys that see, like, you guys receive my text messages and things like that, and that's my separate phone number where everything is recorded. If we talk on the phone through there, that's recorded. The text message change back and forth are recorded. All my Calendly synced up is recorded. I mean, I'm pretty much all I do is real estate, so I'm not like that worried about it. But I'm just saying for anybody else, like, it's good to possibly look into something like that too if you're looking to get into it and worried about getting audited. Go ahead, Tristan. So we'll take Tristan, Jasmine, and then we're done.
Thank you. So my question is just to make sure I'm understanding this right, or you say that's the best situation you think. So I think I'm set up like your fourth option you had, where I have me and then I'm broken off. I have my LLC for my rental income, and then I have my business for myself. My rental brought in 15,000 last year, and I don't. It's a brand new house, so I don't have like much write-offs for it. So would you suggest I now open a S corporation and then charge it a management fee like you were showing?
Did you say you had a second business already? You have
I
a
have a
second one,
landscaping
right?
business, and then I have my real estate business.
Yeah, I'd probably just run it through your landscaping business.
But then my question is,
But
well,
aren't
then either
you
way I would have to pay taxes on it, because then my landscaping would then show an income.
but
You know
you
what I
own your landscaping business, right?
Correct.
So you work on constructing real estate all day long, right? Every day. So you'd be a real estate professional.
I get what you're saying.
Yeah. So I would say I would still keep your LLC separate for the rental property, but any losses created there, you'll be able to use those as a real estate professional. As long as you own more than 5% of a business that's real estate related, and landscaping is definitely a real estate professional type business, it would satisfy that.
Yeah, because I was trying to like build my real estate LLC from my landscaping to like offset the income of the $15,000. But then all that did obviously was just making more money show on my landscaping business.
Yeah.
So I was just getting taxed there anyway.
You get the deduction on one side, but income on the other side. So that's where depreciation comes in on the rental property. You don't want to accelerate the depreciation. You don't want to go watch that first video. I think last time we talked, it was a lot of the cost segregations and accelerated depreciation.
Okay.
But yeah, great question.
Thank you.
All right, so go ahead, Jasmine, and then we're gonna go into the breakout room.
Okay, I'll be brief. So just to make sure I understood correctly, we need to have an S corporation for the business and then LLC for all the multifamily investing. Because right now my business is I buy and resell land. So I know I'm qualified as a real estate professional, but I have everything under one LLC. My capital gains, everything that all the properties that I buy and resell, and then my multifamily investing.
Yes, I would separate those pretty quickly. I would separate them as fast as you can. And that's mostly, there's not it's not really a tax answer or like a tax reason to do it, but the legal liability and the asset protection reasons, just separating an operating business where you're holding yourself out there, you're providing services, that's where there could be some risk. Separate your assets from there, your investments in the multifamily properties or your direct investments. I would definitely put those in a separate LLC.
And why is like one LLC and one is corporation?
Yeah, and they're both going to be LLCs. It's just the one LLC that is taxed as an S corporation, because you're offering services and you're like creating an income. If you're not an S corporation, you would be subject to self-employment taxes. And so really that's one of the main reasons to be able to file a separate tax return and not be subject to self-employment taxes. That's why you do the S corporation or LLC/S corporation. It'd still be an LLC. It's just taxed differently with the IRS. And then you pull the other stuff, all your assets and your investments away from that, just because that would be potentially the entity that has some risk to it. And to just separate that risk from your investments, you'd want that in a separate LLC.
Okay, awesome.
All right,
Thank
so
you.
Rochelle's got the last question. Go ahead.
Sorry, thank you. Brent, thank you so much for being this call. So really quick question for my nurse friend. So I'm trying to get into real estate, pure W-2. I know you've touched on this earlier. Is it the better structure for them would be the S Corp managing the LLC that invested onto the LP deals? Would it something that would benefit them right off the bat? Because I want them to get the tax benefit right from the start.
That's right. That would be the fallback plan if they're not active, they're not spending enough time in it, and they're not real estate professionals, they're not into short-term rentals. That would be the structure I'd recommend. And it's kind of another way to put it, like they're starting a business to manage their rental or to manage all their investments, and they're starting another business, a holding company, to hold all their investments. And so like it's not just for the tax deduction. It's like, no, they are creating a future life and future livelihood. They're creating a business on one side through the S Corp, and they're creating an entity that holds their investments down the road. But definitely a possibility for them.
Brilliant. Thank you so much.
Yep.
All right. Great. Thanks, Brent. You kicked ass. And we will post your info and your contact stuff and your podcast. So a lot of questions that you guys probably have will probably be answered on his podcast as well. So
I'll send over a
reach out.
link. I'll send over a link will get people on our calendar a lot quicker. I've got to decide how I'm going to open up my calendar. I'm thinking maybe I'll do like specific days or weekends and just open it up for you guys, and then just create a specific link for you. So I'll do something. I'll send it over here either tonight or tomorrow. Yeah.
So everybody's gonna have a follow-up email with it. So if you are on the, however you signed up for this, there is a follow-up email that comes out either tomorrow or the day after with the recording and Brent's contact info. So be on the lookout for it. If you don't see it, check your junk mail or message me and we'll get you the copy. And there it is. Wealth Game Podcast, everybody.
There's the podcast. And yeah, thank you, Alex, for having me on, and great questions, everyone.
Yeah.
And I look forward to hopping on again and talking to some of you here soon.
Yeah, will do. So we're going to do a breakout room now. So we're going to give you guys 1 or 2 sessions of breakout. And I know this is not the time to leave. This is the time to really, put your A game on, turn your cameras on, and, connect with somebody, because chances are the person that's going to end up in your room is the person that's got the key to the next thing for you. Okay. Or got the answer for you. So stick around, even though if you might not feel like it, just, do something uncomfortable. Nick, if you can break everybody out into the rooms, you guys got 12 minutes.
There you go.
Keep track of time.
All right.
Yeah, they're good.
Hey, everybody. The main room.
Chill. All right. Well, I finished the orientation video. And I will record the Discord intro tonight.
All right, cool. Because we're gonna send that out with the onboarding email.
I have to upgrade my Loop subscription. Because there's a recording.
What?
Hey, send me into a room, would you?
Send them into a room.
Come on, Alex, what's going on?
Come on, Nick.
I don't see that any participants are assigned to a room.
Well, this is the master room, so there's no better room than this one.
It says you're in room 3. Can you accept it?
You gotta go. You gotta
oh,
break
okay.
it. Hit join.
Here he goes.
Where you going?
Hey, Alex.
Yo,
Fody, how you doing, man?
what's up, bro? How are you?
Good. How was your birthday?
It was awesome.
I bet.
Yeah. Like I
I
think
just
about,
hopped back on.
yeah, about like 100 people showed up. It was pretty insane.
Awesome.
Did 100 people actually come?
Yeah,
Oh my god.
it was crazy.
There's 100 people that signed up, but I was like, there's no way everyone come.
Yeah. I mean, there was a lot of people that showed up that was not on the list.
Really?
Yeah.
Sick.
Yeah, it was a good time. I did a photo shoot right before as well.
Really?
Yeah, you got the pictures.
Oh, yes. I do have the pictures.
How we doing in Murfreesboro and Asheville and all that, Poti? You working with talking to Ian or what?
Yeah, those two deals are, I mean, what the Metro is going in, it's CFO tomorrow. I've been talking to the broker. There's not much we can do with that, but I'm working on some other stuff.
Okay, yeah, we're also looking to bring some supercars into Nashville. So
Awesome.
yeah, I hear
Bring
that.
them to Memphis and collect on insurance. We'll be done in an hour.
Yeah. Well, so you know, we've been trying to book a car out there in Nashville, and it's like to get a Lambo, you got to wait till March.
Yeah.
So,
They can't spell Lambo, let alone Lamborghini.